Everybody, it's Jim Hiles. It is February the 15th. It is Market Tuesday, not Monday, but Tuesday. I'm just back from a little ski trip at Jackson Hole. Had a great time. I thank my friends for allowing me to stay with them. And it seems like when I go away, sometimes the markets just get better all by themselves. And it looks like that's the case after Friday and Monday are pretty ugly days. It looks like today's on the rebound again. We're up probably at least 1% across the board today, but it's been that kind of market. It looks like it's pretty much tied to what's going on in Russia right now. When you look at what's going on, the last couple of weeks we were okay, but it's this Ukraine issue is going to be one of these simmering things, which has got a lot to do with what's going on in the market. And we have no idea the direction of this one. So this is one of those things you can't really do much about. I don't think there's a lot of reason right now to head for the hills, but we're certainly watching this. When you look at the other things going on around the world, inflation we know is just, going crazy. I think I just saw a print 9.7% was the latest. Look, we've got inflation because we were just so far off pace with the COVID shutdown. But this is not necessarily a huge surprise. It just is kind of coming home to roost for a lot of people. And I think you're going to see the supply chains, start to release the demand into the market. We really haven't heard a lot about COVID in the last 7 days anyway, as much as I've heard in prior times. It just seems like the masks are starting to come off. I think it was February for some, March for some, for kids in school and so on. So maybe we're through that phase and we can kind of maybe get back to business. Energy's been on a tear. Let's not forget that energy is up a lot due to global tensions, but you can see this Iranian thing also release more gas to the marketplace, and we can also see just this pent-up demand from coming off COVID driving up prices too. So obviously keeping our eye on this. Bitcoin had a little bounce back, which for those crypto people out there, you're not back to where it used to be, but it seems to be holding on. 2% on the Treasury. We're back over that today. Earnings have come in better than what most people thought. They have beaten, means to the upside, surprised positively, but the market itself just is not responding to that at all right now. Russia raised their rates, which is kind of interesting. They've got more inflation than we do. Maybe they're trying to say something to the marketplace about that. Retail sales, we're going to look at that, which came out pretty good. When you look at total returns on the year, it's hard to say we're not having a correction in the marketplace. We're down 4.3 on the Dow, over almost 12% NASDAQ, 7% on the S&P. Internationals have actually held up better. So we kind of said a lot of this last year, that valuations were lower across the pond, so to speak. And that's proving out to be the case. We're going to stick with that for the time being. We do have an allocation to international. And I think from an overall standpoint, I think it's one of these things where you stay with what we're comfortable with. What we're comfortable with right now is we like U.S. stocks that are making quality earnings. They're profitable. They're not heavily levered, and we're basing valuations on actual profits, not expectations of sales. We think those companies are going to stand the test of time this year. We also think that value is probably going to be better than growth. So those industrials, banks, the energy, the things we've been talking about all along. We've got a tilt in our portfolio really away from growth now, which is a regime shift hasn't happened in at least 5 years. Small caps are still kind of getting beat up. They haven't really been recognized as an opportunity yet. So that's not helping the portfolio. The emerging markets have actually done okay, depending on where you're looking at. Bonds have actually been the biggest surprise this year. Their negative performance on the bond. We've had interest rates go up and bond prices go down. No kidding. We've been talking about that for a long time too. That's why we have alternatives in the portfolios. So we're good where we are right now. We're obviously cautious, and every day it's going to be one of those things. We're going to be up and down like a roller coaster, but I think overall we're in a good place in the portfolios. We're obviously keeping an eye on everything, and we're not afraid to go to cash if we have to. But right now we're going to be cautious. All right. We'll talk to you soon. Thanks, Jim Hiles.